Preparing for a finance manager at Airbus interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a finance manager at Airbus? Airbus appeals to me because finance directly influences industrial performance, customer commitments, investment decisions, and long-term program profitability. I would bring strong management accounting, forecasting, and stakeholder skills, while staying close to operations rather than working only through reports. The finance manager role suits me because it combines technical discipline with leadership and commercial judgment. I am particularly motivated by helping engineering, procurement, manufacturing, and sales translate operational choices into transparent financial outcomes. While answering, connect Airbus's global aerospace mission with your finance leadership experience, commercial curiosity, operational partnership, and motivation to improve decisions across long-term, complex programs. Question 2. What would be your priorities during your first 90 days? My first priority would be listening and learning, meeting the finance team, program leaders, operations, procurement, and business partners. I would understand the reporting calendar, key performance indicators, major contracts, forecast assumptions, and control requirements. Next, I would reconcile reported results to operational drivers and identify the most material risks. By day 90, I would aim to deliver a clear risk and opportunity view plus 1 or 2 measurable process improvements agreed with stakeholders. Make sure to cover stakeholder mapping, understanding Airbus's reporting calendar and controls, reviewing key risks, learning program economics, validating data quality, and identifying a few practical improvements without disrupting delivery. Question 3. How would you explain a financial variance to a non-finance program leader? I would begin with the headline, what changed, by how much, and whether it affects the full-year outlook. Then I would bridge the variance using operational drivers such as volume, mix, labor efficiency, material pricing, foreign exchange, or timing. For example, I might explain that a cost increase reflects delayed deliveries rather than uncontrolled spending. I would finish with actions, accountable owners, and a revised forecast, ensuring the conversation leads to decisions rather than merely describing history. In your answer, talk about separating price, volume, mix, productivity, timing, foreign exchange, and one-off effects, using operational language, quantifying causes, and agreeing corrective actions with owners and deadlines. Question 4. How do you build a reliable budget and forecast for an aerospace business? I build forecasts from operational drivers rather than applying broad percentage changes. I would model production rates, deliveries, labor hours, material costs, supplier assumptions, contract milestones, cash timing, and foreign exchange. I would challenge assumptions with program and functional owners, then create base, downside, and upside cases. Monthly actuals would feed a rolling forecast, with variances analyzed for root causes. That approach makes the forecast both more credible and more useful for management decisions. Be sure to mention bottom-up operational drivers, program milestones, production rates, labor and material assumptions, contract terms, scenario analysis, challenge sessions, and regular actual to forecast learning. Question 5. What financial KPIs would you monitor as an Airbus Finance Manager? I would monitor revenue and margin development, contribution by program, order intake, backlog quality, delivery performance, cost productivity, working capital, operating cash flow, and forecast accuracy. For long-term programs, I would also track estimate at completion movements, progress measures, contract risks, and engineering or supply chain milestones. The key is linking financial outcomes to leading indicators. A deteriorating supplier recovery rate, for example, may signal future cost or delivery pressure before it appears in reported margin. Focus on profitability, revenue recognition, cash conversion, working capital, cost productivity, delivery performance, backlog, forecast accuracy, program risk, and leading operational indicators rather than relying on one metric. Question 6. How would you assess the profitability of a long-term aircraft program? I would assess profitability through a disciplined estimate at completion model covering contracted pricing, expected deliveries, production costs, learning curves, supplier commitments, escalation, customer options, and remaining risks. I would compare actual progress with the original business case and investigate changes in cost to complete or schedule. Sensitivity analysis would show the impact of production delays, material inflation, or foreign exchange. Finally, I would ensure assumptions are documented, independently challenged, and reflected consistently in reporting and decisions. Discuss contract economics, expected deliveries, pricing, production costs, learning curves, customer options, escalation, cash profile, risk provisions, estimate at completion governance, and sensitivity to major assumptions. Question 7. What is your understanding of revenue recognition for long-term contracts under International Financial Reporting Standards 15? Under International Financial Reporting Standards 15, I would first identify the contract and its distinct performance obligations, determine the transaction price, and allocate consideration appropriately. Where control transfers over time, revenue is recognized using a reliable measure of progress, often based on costs incurred or another operational measure. I would carefully assess variable consideration, contract changes, and onerous developments. Strong controls around estimates are essential because changes in forecast cost can materially affect both current revenue and future margin. Cover identifying performance obligations, transaction price, contract modifications, overtime recognition, progress measures, variable consideration, contract assets and liabilities, and the importance of reliable estimates and controls. Question 8. How would you manage an unfavorable estimate at completion movement? I would first validate whether the movement arises from actual performance, revised scope, supplier information, schedule changes, or a modeling error. I would separate incurred variance from remaining exposure and challenge recovery assumptions with the program team. Then I would assess implications for revenue, margin, provisions, cash, and disclosures. I would present management with a transparent bridge, downside sensitivities, and specific mitigation actions. After approval, I would track those actions through the monthly forecast process. Explain how you would validate the change, isolate root causes, quantify remaining exposure, challenge recovery assumptions, assess accounting implications, communicate transparently, and establish a monitored mitigation plan. Question 9. How would you improve working capital in a manufacturing environment? I would analyze working capital by driver rather than issuing a general reduction target. For inventory, I would examine demand, safety stocks, lead times, shortages, and obsolescence. For receivables, I would review billing milestones, disputes, overdue balances, and collection ownership. Payables would require disciplined supplier term management without damaging resilience. I would create a cash bridge with operational owners, prioritize the largest opportunities, and monitor both cash benefits and unintended effects on delivery performance. Mention inventory segmentation, supplier terms, customer billing, milestone collection, overdue receivables, production planning, obsolete stock, cash forecasting, and balancing liquidity improvements against operational resilience. Question 10. How do you manage foreign exchange risk in a global aerospace company? I would start by mapping currency exposures from contracts, procurement, payroll, and forecast cash flows, distinguishing transaction risk from translation effects. I would look for natural hedges before recommending financial hedging and coordinate with Treasury under the approved policy. Forecast quality matters because inaccurate volumes can create over or under hedging. I would explain both economic and accounting impacts clearly, monitor residual exposure, and ensure documentation supports effective control and consistent reporting. Cover exposure identification, transaction versus translation risk, forecast quality, natural hedges, Treasury coordination, hedge policy, accounting impacts, and communicating residual risk to operational stakeholders. Question 11. Describe a time you challenged a senior stakeholder's financial assumption. In a previous role, a business leader assumed a supplier recovery would offset a material cost overrun. I reviewed the contract, recovery history, and delivery evidence, then showed that the timing and probability were materially weaker than the forecast assumed. I avoided presenting only a problem. I offered a base case, downside case, and negotiation actions. The forecast was revised, the risk was escalated appropriately, and the team secured a partial recovery while protecting decision credibility. Use a specific situation, demonstrate respectful evidence-based challenge, explain the financial and operational consequences, show how alternatives were developed, and finish with the measurable outcome. Question 12. How would you handle conflict between finance and operations? I would begin by understanding what operations is trying to achieve and why finance's concern is creating friction. Then I would separate facts, assumptions, and constraints, using a common data set rather than competing opinions. I would frame the issue around shared objectives such as delivery, safety, customer satisfaction, and sustainable margin. If disagreement remained, I would present clear options and consequences to the appropriate decision maker. Afterwards, I would maintain the relationship and review the outcome together. Discuss shared objectives, fact-based analysis, listening, separating facts from assumptions, clarifying decision rights, escalating proportionately, and preserving a constructive partnership after disagreement. Question 13. What internal controls are most important in a finance manager role? The most important controls protect the integrity of transactions, estimates, and reporting. I would focus on segregation of duties, approval limits, journal entry review, account reconciliations, access management, master data controls, and documented management review. For aerospace programs, estimates and contract changes deserve particular attention because they can materially affect results. Controls should be practical and evidenced, not merely designed on paper. If a deficiency appears, I would assess its impact, agree remediation, and verify closure. Mention segregation of duties, journal approval, account reconciliations, master data governance, estimates, access controls, evidence retention, management review, and timely remediation of control deficiencies. Question 14. How do you ensure month-end reporting is accurate and delivered on time? I would establish a documented close calendar with clear owners, dependencies, review points, and escalation deadlines. Before close, I would focus on high-risk areas such as accruals, revenue estimates, inventory, provisions, intercompany balances, and program adjustments. Reconciliations and analytical reviews would target unusual movements, not simply confirm balances. I would use standardized templates and automated checks where possible. After reporting, I would capture recurring issues and remove root causes so each close becomes more predictable. Cover a clear close timetable, ownership matrix, materiality, reconciliations, accrual quality, estimate reviews, automated checks, issue escalation, and post-close lessons learned. Question 15. How would you evaluate a capital investment proposal for Airbus? I would evaluate the proposal in both strategic and financial terms. First, I would confirm the operational need, capacity assumptions, expected productivity, implementation timing, and alternatives. Financially, I would calculate cash flows, NPV, IRR, payback, working capital effects, and residual value, then stress test utilization, inflation, delays, and demand. I would also assess execution and supplier risks. Approval should include measurable benefits, accountable owners, and a post-investment review comparing actual performance with the original case. Include strategic fit, capacity and productivity benefits, NPV, IRR, payback, cash timing, utilization, risks, sensitivity analysis, implementation capability, and post-investment performance tracking. Question 16. How would you analyze the financial impact of a production rate increase? I would avoid assuming that higher volume automatically improves profit. I would model incremental revenue, pricing, unit cost learning, labor capacity, overtime, tooling, supplier constraints, inventory, quality costs, and required investment. I would also assess whether bottlenecks shift elsewhere in the production system. Multiple scenarios would show the effect of slower ramp-up or supplier disruption. The recommendation would compare incremental margin and cash generation with execution risk, customer commitments, and the organization's ability to deliver reliably. Discuss incremental revenue, unit cost and learning effects, labor capacity, supplier constraints, inventory, overtime, tooling, quality costs, cash needs, and scenario-based profitability rather than assuming linear benefits. Question 17. What would you do if a key supplier announced a major cost increase? I would first validate the supplier's cost drivers, contractual entitlement, timing, and evidence. Then I would quantify the impact by program and unit, including inventory, delivery, quality, and cash consequences. I would work with procurement and engineering on negotiation, redesign, alternative sourcing, and volume options, while assessing customer pass-through possibilities. I would prepare base and downside scenarios for leadership and update the forecast only when evidence supports it. The objective is controlled mitigation, not an optimistic assumption. Mention validating the claim, contractual rights, alternative sources, production disruption, inventory, customer pricing, negotiation strategy, scenario modeling, and cross-functional governance. Question 18. How do you lead and develop a finance team? I lead by setting clear standards while giving people ownership of meaningful outcomes. I would understand each team member's strengths, development goals, and workload, then combine coaching, delegation, technical training, and exposure to operations. Regular one-to-ones would address performance early and create space for questions. I also value cross-training and succession planning so the team is resilient. High standards matter, but so do psychological safety, recognition, and explaining why the work affects the business. Focus on clear expectations, coaching, delegation, technical development, business exposure, succession planning, psychological safety, performance feedback, and adapting leadership to individual capability. Question 19. Tell me about a finance process you improved. I improved a forecasting process that depended on disconnected spreadsheets and inconsistent assumptions. I mapped the workflow, identified duplicate inputs and weak ownership, then introduced a standardized driver-based template with validation checks and a central assumption log. I involved operations early, so the solution reflected how teams actually worked. Forecast preparation time fell by approximately 30%, review discussions became more focused, and the process produced a clearer audit trail. I then documented ownership and embedded monthly quality checks. Select a measurable example, explain the original problem, diagnose root causes, involve users, redesign controls or automation, quantify benefits, and describe how the improvement was sustained. Question 20. How would you use data and digital tools to improve finance performance? I would start with reliable definitions, ownership, and data quality before building dashboards. Then I would automate repetitive reconciliations, consolidate operational and financial drivers, and use exception reporting to focus attention on material risks. A useful dashboard should explain movement and support a decision, not simply display many metrics. I would involve end users, protect access and confidentiality, and retain review controls. Digital tools should augment judgment, especially when assumptions or program risks require human challenge. Discuss reliable data foundations, ERP discipline, dashboard design, automation of repetitive work, exception reporting, user adoption, cybersecurity, and preserving professional judgment over automated outputs. Question 21. What would you do if you discovered a potentially material reporting error close to the deadline? I would not conceal or postpone the issue to protect the deadline. I would confirm the facts, quantify the potential impact, contain further postings, and notify the appropriate controller or finance leader immediately. Together, we would assess materiality, correction requirements, disclosure implications, and whether audit consultation is needed. I would document the judgment and evidence, communicate clearly to affected stakeholders, and afterward investigate root cause. Integrity and a reliable reporting process are more important than an artificial deadline. Cover immediate fact-finding, containment, materiality assessment, escalation, correction, documentation, auditor engagement where appropriate, root cause analysis, and transparent communication without sacrificing control quality. Question 22. How would you approach an impairment or provision assessment? I would begin by identifying triggering events, such as persistent underperformance, cost escalation, delays, or adverse market changes. I would then define the relevant asset or obligation, build supportable cash flow scenarios, and assess recoverable value or expected costs using appropriate assumptions. Discount rates, probabilities, and sensitivities should be challenged independently because small changes can matter. I would document the rationale, involve technical accounting where necessary, and ensure the conclusion is reflected consistently in forecasts, provisions, and disclosures. Mention identifying triggering events, defining cash-generating units or obligations, forecasting recoverable amounts, probability-weighted scenarios, discount rates, sensitivity, documentation, and independent challenge. Question 23. Describe how you would prepare for an internal or external audit. I would prepare through a risk-based plan rather than waiting for audit requests. I would identify significant accounts, estimates, contracts, controls, and prior findings, then assign owners and deadlines for complete evidence. Reconciliations and explanations would be completed before fieldwork, with assumptions consistent across finance and operational teams. I would respond promptly and transparently, escalate disagreements through the proper channels, and track open items to closure. Audits should also reveal opportunities to strengthen processes and documentation. Include risk-based planning, evidence ownership, reconciliations, judgmental estimates, control testing, consistent explanations, issue tracking, auditor independence, and treating audit as a process improvement opportunity. Question 24. How would you balance short-term cost reduction with Airbus's long-term competitiveness? I would distinguish structural productivity from cuts that merely defer cost or increase risk. Any proposal must protect safety, quality, compliance, critical skills, and customer commitments. I would compare total cost, including rework, disruption, supplier dependency, and lost capability, rather than focusing only on immediate expense. I would prioritize sustainable actions such as process simplification, design to cost, procurement leverage, and better capacity utilization. Each initiative would have measurable benefits, owners, timing, and a review of unintended consequences. Talk about distinguishing waste from strategic investment, protecting safety and quality, considering total cost, supplier resilience, capability retention, scenario analysis, and linking savings to sustainable productivity. Question 25. What does strong business partnering look like for a finance manager at Airbus? Strong business partnering means being close enough to understand operational reality and independent enough to challenge weak assumptions. I would provide timely insight on profitability, cash, capacity, contracts, and risk, translating finance into decisions that program and functional leaders can act on. I would not simply approve or reject requests. I would offer alternatives and clarify trade-offs. Credibility comes from accuracy, consistency, and follow-through. Ultimately, partnership is measured by better decisions and sustainable business outcomes. Emphasize commercial understanding, credibility, constructive challenge, timely insight, translating finance into operational decisions, accountability, ethics, and measuring partnership through improved outcomes rather than meeting attendance. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.